Assalamu alaikum, welcome back to the accounts. So in this video we'll be starting a new topic, which is bank reconciliation statement, and particularly in this video, in the first part of this topic, we will be discussing its background, that why is there a need to prepare a bank reconciliation statement. So let's begin. Now, as we already know that all the bank related transactions of the business are recorded in the bank account, of course, either in the bank T account or in the 3-column cash book, which contains cash related transactions, the discounts received and discount allowed, and the bank column as well. So all the bank related transactions, for instance the expenses paid through bank, operating expenses, financial expenses, or the payments to suppliers, or the payments to bank, for instance interest on overdraft or bank charges, all of that would be recorded in the bank account. Similarly, the items that are debited in the bank account would be the receipts from your debtors, or if there are cash sales which are right away debited in the bank account, so that, or any other incomes such as your interest received or dividends received, etc., etc. Or if there's a loan, right, if you are giving out a loan, so that would be credited in the bank account, and if we are taking a loan, so that would be debited in the bank account. So all of these transactions will be recorded in the bank account, which is maintained by the business, which is maintained by the bookkeeper, right? This should mean that at the same time the bank will also be recording all of those transactions related to our business in its own account. When we are recording the bank related transactions, the bank would also be recording that in its own account with the name of our business. So ideally, when we compare the balances of the two, that is cash book, the balance which the business will extract in the end, at the end of the month, the balance carried down extracted in the cash book should match with the balance extracted by the bank for our business account, which will be shown in the bank statement. This is a statement which is prepared, which is sent by the bank to the business at the end of each month. We will be learning about that in a minute. So ideally, the balances of these two accounts or of these two statements should match, because both of them would be containing the transactions related to the same business bank account. However, this is not the case always. Why? Now, this is where the topic comes in. This is because there are some items, there are some transactions which are there, which are present in the cash book, but they are not there in the bank statement, and vice versa. When we compare the two, when we compare the bank statement with the cash book, we would come to know of some items which are there in the bank statement but not in the cash book, right? So there would be some items present in the bank statement but not in the cash book, and there would be some items present in the cash book but not in the bank statement. And that is why, in order to reconcile, in order to match the balances of the two statements, that is the bank statement and the cash book, of course they should match because the transactions are related to the single business, so they both should match. We prepare a new statement which is called the bank reconciliation statement. So right now we have studied about three statements. The first one is the cash book, right, which we already know. We know how to prepare a cash book. So the business prepares a cash book and it extracts the bank CD at the end of the month. Then the second statement is the bank statement, which is received from the bank. The bank prepares this statement, and when we compare the two, we come to know of some differences which are there in the statements, and because of that our CDs are not reconciling, and that is why we prepare a bank reconciliation statement. We means the business prepares, not the bank. The business prepares a bank reconciliation statement to reconcile the two. So there are three things which you have to look for, which you have to see, that which balance is given to you, why is that given to you, how is that affecting the bank reconciliation statement, what will go where, that we will learn about. So basically there are three things. Now let's move towards bank statement. Then what is a bank statement? So bank statement, as the name also suggests, that it is prepared and it is sent by the bank. A statement prepared and sent by the bank to the business at regular intervals. Usually it is monthly or as requested by the customers. And what does it show? As we have already discussed, that it shows all the business bank related transactions for that month or for that interval, and at the end it also shows a balance carried down, that how much is there in your business bank account. It could be overdrawn as well, right? We know that what is overdrawn. Overdrawn means an overdraft, which is a liability on the business, right? Business bank account, if it's a positive balance, that is an asset. An overdrawn balance is a negative balance, which is an overdraft. That means you have extracted, you have taken out money more from your business at bank account than it was there in your account. And that is done after taking permission from the bank, as there is a contract between the bank and the business, that how much you can take out from your account. There's a limit to it, right? So that can there can be an overdrawn balance as well. We will study that in the later videos. So this bank statement is sent by the bank, and what do we do with it? The business tallies this statement with its cash book, to verify, to identify, to see if there are any transactions which the business hasn't recorded, or if there are some transactions which the bank hasn't recorded, or there could be errors in the recording of these transactions as well. So that all of that has to be identified in order to match the balances of the two statements. And how does a bank statement is prepared? It looks like this. It is prepared in 3 columns. The first part shows the date of transactions. The second part shows the details, that what were the accounts involved in the bank statement, and then 3 columns are of debit, credit, and the balance column. So bank statement shows balance after every transaction at the end, not at the end of the month as well. It doesn't just show the CD balance, but also the balance after every transaction as well. So if you just see that there's a balance brought down, that is given in the balance column. Then there is a payment from a debtor ABC, which is increasing the balance. It was 450, but it is increasing the balance by 450, so now it is 950. Then there were some payments to the creditors, so that must have decreased the balance by how much? By 300. So 950 less 300, it is now 650. And then so on and so forth. Bank charges, which are deducted by the bank, 100, that is also decreasing the balance. Credit transfer, you learn about that. Standing order, you learn about that as well. So what do we know about the bank statement so far? That it is prepared and sent by the bank, and it shows the balance after every transaction, and it must tally with the cash book, and for that we prepare a bank reconciliation statement. Now I will tell you a very interesting fact about bank statement, which some of you might have noticed so far, that is the items debited in the cash book. Items debited in the cash book. What items come in our mind which are debited in the cash book? For instance, payments from the debtors, or any other incomes received in the bank account. All of that is debited in the bank account, so of the cash book, right? In the cash book. So items debited in the cash book are recorded on the credit side of the bank statement. And similarly, items credited in the cash book are recorded on the debit side of the bank statement. This is something different, right? Because if we just have a look at the bank statement again, you can see that debtor paying into the business bank account is a debit entry in the cash book. However, it is being recorded on the credit side, and it is also increasing the balance as well. Even if being recorded, shouldn't it decrease the balance? Similarly, we are making a payment to a creditor, that is being shown on the debit side of the bank statement. I'm not talking about cash book, but bank statement, that is being debited in the bank statement, and it is also decreasing the balance. Shouldn't it increase the balance if it is being debited? And so on and so forth. So uh, the fact is that items debited, whatever is debited in the cash book is recorded on the credit side of bank statement, and what is credited in the cash book is recorded on the debit side of the bank statement. Now if we remember this thing, we can solve the questions very easily. Now why is that so? Why is the treatment like this? Why is the treatment so opposite? That we will learn in the next video. So I'll see you there.